Hey guys, welcome back to another video. Today we are covering Chapter 5 of the International Macroeconomics video series. I am working off the second edition by Robert C. Feenstra. I've provided a link in the video description where you can check out the book if you are interested in buying it after watching these videos. And in this chapter, we're talking about the inflows and outflows of different transactions and how it impacts the aggregate economic measures of an economy. So it's the balance of payments chapter. And this is one of those chapters that either you get it right away and it's really easy, or you kind of struggle with it initially. And you kind of need a few examples to wrap your head around it. So hopefully I can kind of go through it slowly and you guys will understand. As always, please like and subscribe to the channel if you do enjoy it. I appreciate all the support that I've received so far. It just keeps me going and keeps me making more and more videos to help you guys out. Alrighty, so let's get started. So a closed economy is characterized by a circular flow of payments in which economic resources are exchanged for payments as they move through the economy. Economic activity is measured and recorded in the national income and product accounts. In an open economy, to account for the cross-border flows, the balance of payments, the BOP accounts, is used to measure activity. And probably in the introductory macroeconomic courses, you've covered the different ways to calculate aggregate economic activity. You learned how to calculate, economic activity through the expenditure, the product, and the income approach, right? The expenditure, looks at the demand for goods. It examines how much is spent on final goods and services, and that can be captured through the G&E measure. The product approach looks at the supply of goods and its measure of the value of all goods and services produced, minus the value of imports. And the income approach focuses on payments to owners of factors. It tracks the amount of income they receive, and that's captured through the G&I measure. And so again, in a closed economy, you've probably done this 100%. You've done this in your introductory macroeconomic course, where you looked at simple transactions and how either it was the income paid out, the net income earned by a corporation, the income paid out to salary and the taxes, or it was the expenditure, so the amount that businesses paid to produce the amount that they produced, or the product approach, which was the final value of the goods that were produced, right? And so looking at gross national expenditure, the total expenditure on final goods and services by home entities in any given period is measured through consumption, investment, and government spending, so C plus I plus G. So where do these payments flow next, right? So in a closed economy, that consumption, where does that money that we consume on consumption, so where we buy assets and all that, where does that go? Well, it goes to gross domestic product. It goes to actually purchasing the goods that were produced in that economy. So a country's gross domestic product is the value of all goods and services produced as output by firms, minus the value of all goods and services purchased as inputs. In a closed economy, GNE, so gross national expenditure, equals GDP. So where do the payments flow next? So now that gross national expenditure, you've spent all this money, so either through consumption, investment, government purchases, it goes and it purchases these assets, which are represented by gross domestic product, which these assets are produced for that respective value. Well, that acquisition of that assets is represented as income, and that can be illustrated through gross national income, GNI. In a closed economy, expenditure is the same as product, which is the same as income. Therefore, GNE equals GDP plus equals GNI, right? So each of these three measures, each of these aggregate measures in your introductory macroeconomic course equal the same number, right? And that's in a closed economy. And that's usually the example they provide to really illustrate the different measures and how to calculate and come up with the same number of aggregate economic activity. However, in an open economy, there flows ins and out of the economy that really distinguish GNE, GDP, and GNI. And so if we look beyond this illustration over here, which is very simple to understand, boom, right? Now we have to account for the outflows and inflows, right? So when a nation opens itself to trade with other nations, all of the extra payment flows to and from the rest of the world must be recorded. This is recorded in the nation's balance of payments account, so the BOP accounts, as we said before. So let's start from the very beginning. In an open economy, some home expenditure is used to purchase foreign final goods and services. The difference between the payments made for imports and received for exports is called the trade balance. So we start off again with the gross national expenditure, right? So usually in a closed economy, what you spend the money that you spend goes to the producers that produce that domestically. But in an open economy, you can spend that money and acquire domestic assets, or you can acquire foreign assets. If you were to acquire foreign assets, it would be reported in the trade balance because it's an import of a good or a service. In addition to expending on foreign assets, there's also the outflow, which is some producers will export some of their products, and therefore there's also an export outside. Okay, and so the trade balance is essentially net exports, right? It is the difference between the value of exports of goods and services and the value of imports. Now, somehow home GDP is paid to foreign entities for foreign service imports. That is domestic payments to capital, labor, and land owned by foreign entities. The value of factor service exports minus factor service imports is known as net factor income from abroad, NFIA. So essentially, we've talked about G&E and accounting for the trade balance. So some expenditure goes and acquires foreign assets, and some production is sold internationally. And so that is recorded in the trade balance. Now we're at the GDP measure. In addition to the GDP, so the amount earned by those businesses, the amount that is produced, some of the production will originate from foreign markets. When we talk about, a country has, two businesses. Say, for example, we simplify, okay? And there is a country A, and this country has two businesses. That's all that is recorded in gross domestic product. One of the business is based in domestically, and then the second business has a branch in the foreign market in Japan, say, for example. Now, the net income that is earned in that foreign branch is still the country A's income, really, right? But it's earned in the foreign market. And so that's a net factor income from abroad, right? So when we talk about the value of export of factor services and the value of import of factor services, so if we have that plant out there, we're exporting that capital to that country to produce a respective good in that country, and the amount that we receive is that net factor income from abroad. So the net amount is, say, for example, there are other countries, so foreign countries might have a factory in our country, right? And so we buy assets from that factory, and the net income does not stay in this country. It leaves and it goes back to that foreign country because it's their income, right? And so that's an outflow. So there are inflows and outflows of net factor payments, right? And some of the examples that they talked about were, of course, capital, labor, and land owned. So not only is it, the amount that we pay out to employees, it can be, the capital that's invested, or also, the net income earned on different transactions. Okay? So the home country does not retain all of its income earned, which is represented in G&I. Domestic entities might give it away for reasons such as foreign aid or remittances. So now we've talked about G&E, which is gross national expenditure. We account for the net exports that might leave or enter the country. Then that gives us our GDP. With our GDP measure, we then have to account for the net factor income from abroad. That might either be an inflow or an outflow. And then we get to our gross national income. Now, after gross national income, that income that we earned from either abroad or from domestically, which was accounted for in the net factors income section, that can be used either to stay domestically or can be sent outside. It can leave the country again. And the best example is remittances. And remittances are essentially, even my family does it, and a lot of, immigrant families, what they do is, they immigrate to a country, and then they earn, probably a higher wage than where they immigrated from, and then they send back some money to help out family members. That's a remittance, right? And there are a lot of developing markets that depend on that remittance, right? And so, especially, I can only imagine how much it is. I don't know the exact figure, but especially in the U.S., where there are so many different families that have immigrated to that country to, chase the American dream, and then they send back some money. And so there are, billions of dollars that are sent out, and that is represented in the net unilateral transfers, the NUT account, which equals the value of the unilateral transfers the country receives minus those it gives to the rest of the world. And usually for developed markets, net unilateral transfers are negative because there are more outflows than inflows, whereas in developing markets, and I know in Vietnam, I was doing some research on that country a few months ago, net unilateral transfers are largely positive. So there's a huge surplus that the country depends on, and especially through tax revenue as well. So the balance of payment accounts collect together the trade balance, the net factor income from abroad, and net unilateral transfers, and report this sum as the current account. And you can see that illustration. So TB plus NFI plus NUT all sum up to equal the current account. So adding GNE plus CA gives us GNDI, right? And we'll illustrate the algebraic version later on in the presentation. So asset exports also increase resources available for spending at home. The value of asset exports minus asset imports is called the financial account. This is added to GNDI, so gross national disposable income. So in addition to the current account, which is made up with the trade balance and net factor income from abroad and then net unilateral transfers, there's the financial account. So when we're talking about the inflows and outflows of goods and services, those are the purchases. But what about a home? What about, stocks? These are financial assets, and those imports and exports of those financial assets, which I'll give you an example. Say, for example, you are a foreign buyer. I am the domestic owner of a home, and you purchase my home. That is the export of an asset. I'm exporting that asset to you, the ownership of that asset to a foreign buyer, and I receive cash. That is reported in the financial account. In addition, some countries transfer assets as gifts. That is measured in the capital account. So in addition to remittances, which are represented in the net unilateral transfers, there can be debt forgiveness. So say, for example, a developed country holds a lot of bonds in a developing market, and that developing market has gone through some economic troubles, and it's asking for debt forgiveness, and the developed market goes through with it. Well, that forgiveness needs to be reported. That net loss of initial capital that was invested in those bonds needs to be represented in the capital account, the KA, right? So now let's look at the algebraic version of this. So to adjust GNE, so the initial gross national, so as always, follow this system. We start off at step 1, TB, get to step 2 over here, which is GDP. You add net factor income from abroad, you get your gross national income. Then you add net unilateral transfers to get your gross national disposable income. You then add your gross national disposable income plus FA plus KA, and then eventually goes all the way around to GNE again. Okay, that is more of a visual illustration. The algebraic version is, so we start off with GNE. And so GNE is made up of, as I said at the initially, consumption plus investment plus government spending. So that's GNE. You then add the trade balance. So you add the trade balance, GNE plus the trade balance to get the GDP. So C plus I plus G plus the export of final intermediate goods and services minus the import or net the trade balance plus the trade balance equals gross domestic product. Okay. Now, moving on, an example of trade and capital services is foreign direct investment. So U.S.-owned factories in Ireland generate income for their U.S. owners. I already talked about this, and that income that is generated is then coming into the country. So accounting for these income flows, gross national income, so total income earned by domestic entities, is given by GDP plus the income from overseas. So in addition to GDP, which is GNE plus the trade balance, you then add net factor income from abroad, and that gives you GNI. And I'll go back one more time just to show you. So GNE plus TB equals GDP, GDP plus NFI equals GNI, and so on and so on. And as you can see, then we'll add GNI plus NUT, and then GNDI plus FA plus KA all the way back to GNE. So that's kind of the way we're following it. So many international transactions take place outside of markets. International non-market transactions of goods and services and income include such things as foreign aid in the form of official development assistance, so ODA. So now the algebraic version of GNDI, so gross national disposable income, we have to account for that net unilateral transfers. So this would be GDP. Just would be GNI, right? As you can see, so GNE plus TB plus NFA and FIA is GNI plus NUT, so now net unilateral transfers equals GNDI, gross national disposable income. Okay, so just talking about again the consumption and talking about gross expenditure. So consumption makes up about 70% of GNE, while government consumption accounts for about the 15%. Now, investment accounts for about the remaining 15%, but it fluctuates much more than C and G. So whenever you see a big increase in GNE, whenever you see that, usually that's really the the big driver of that change in G&E comes from investment, right? They're either, it's very pro-cyclical. So if the economy is performing very well, investment will make up a much larger percentage of G&E. And if there's a recession, then G&E, the percentage of investment will probably be much lower. Okay? So as we talked about before, GNDI, so the gross national disposable income equation, can be written as Y equals C plus I plus G plus CA. Remember, so GNE, gross national expenditure, is C plus I plus G. So that's gross, and then adding the current account, which is TB, plus net factor income from abroad and plus net unilateral transfers, which sums up to the current account, equals GNDI. So this is gross national disposable income. This equation tells us that the current account represents the difference between national income, GNDI, and gross national expenditure, the GNE. Okay? So the previous and then we can kind of illustrate it this way. So you have your Y equals C plus I plus G plus CA. So this is your GNE plus your CA, right? And so GNDI, so gross national disposable income, which is represented by that Y, is greater than GNE, which is C plus I plus G, if and only if CA is positive. If CA is negative and there is a deficit, then GNE is much higher than GNDI. Okay, and also looking at the savings formula. So recall total savings is represented by private savings plus government savings. We covered this in a previous chapter, and that equation sums up to Y, which is gross national disposable income minus consumption minus government spending. So that is the formula for total savings in the economy. And we can actually represent this, we can actually illustrate the uses of savings, which is savings equals investment plus current account, right? So savings can either be put towards investment or put towards financing the current account balance. And so we'll expand this once again. So S is greater than I if and only if the CA is positive. So savings, say for example, the current account was 0. Then savings must equal investment. So say for example, you have $1,000 in savings, and you make $1,000 in investment, then your current account is 0. But if you have $1,000 in savings and you invest about only $500, then the remaining $500 is put towards the current account, and therefore the current account must be positive, and it's in surplus. This makes sense when considering where savings can be used. Not only can it be invested, but it can also be sent abroad through imports, exports, factor payments, or transfer remittances, right? So that savings can be put towards the trade balance, so it can be put towards importing more foreign goods. It can be put towards the net factor income from abroad, so it can be sent out to pay for foreign factor income. So say for example, the Japanese company owns a automobile plant in my country. I can finance the payment of their employees, right? And so I buy more from that company. So that savings can go towards there, or net unilateral transfers. I can send my savings to foreign family members in another country. Okay? So as before, our private savings equation is the gross national disposable income minus tax minus consumption. And for the government, it is tax minus government spending. Right? So this is just a fuller formula for savings. And we already talked about this in another chapter, so I won't spend too much time. Now, the financial account is usually where people kind of struggle and are much more afraid because there is a little bit of a confusion, but I'm going to provide some examples. So let's start off. So the financial account records transactions between residents and non-residents that involve financial assets, as I said, stocks or real estate. The total value of financial assets that are received by the rest of the world from the home country is the home country's exports of assets. And the total value of financial assets that are received by the home country from the rest of the world in all transactions is the home country's import of assets. So as I said before when we were looking at that, say for example, you are a homeowner in the US and you sell your house to a Japanese buyer. You are exporting that asset to them. If you were to buy a home in Japan as a US citizen, you are importing an asset. Okay? So here's another example. I am a Canadian investor. If I sell you my house in Florida, you have imported a financial asset because that is a domestic asset that is getting back. It's coming back to the U.S. as a U.S. buyer. If I sold you if you sold me the house, then you have exported that financial asset. So you are a U.S. buyer. I am a Canadian investor. If I own a home in Florida, it is an external asset for me. It's a foreign asset, and I'm selling it back to you as a U.S. buyer. You are importing that asset back. If if I am buying that house from you, so you own that house in Florida, it's a domestic asset for you, and you sell it to me as a foreign buyer, that is exporting that financial asset. Not sure if I can go even further than that. That should pretty much cover, the import and export of that. So the financial account measures all movement of financial assets across international borders. This means the movement from home to foreign ownership, even if the assets don't physically move. It's just a transfer of ownership. Okay, and the capital account covers two remaining areas of asset movement of minor quantitative significance. One is the acquisition and disposal of both non-financial, non-produced assets, such as patents, copyrights, and trademarks. The other is capital transfers. An example would be forgiveness of debt, as I talked about before. The capital account is much more significant for developing countries rather than developed countries. Okay, so really, the big confusion for the foreign account, the FA account, really comes from the difference, because there are two types of assets. There's domestic assets and there's foreign assets. And so you have to account for both. So assets traded in the financial account can be broken down into two types: assets issued by home entities and assets issued by foreign entities. When a home entity holds a foreign asset, it is called an external asset of the home country. When a foreign entity holds a domestic asset, it is called an external liability. Okay, so when, say for example, you are based in Canada and you own a property in Japan, that is an external asset to Canada. But if you are based in Canada and Japan buys your home in Canada, that transaction now becomes an external liability, because it's being taken out. It's not being literally taken out, but the ownership is being transferred out of the country, and therefore becomes an external liability. Oh, another example. Here you go. When a Japanese firm acquires an automobile plant in the U.S., the acquisition is an external liability for the U.S. because ownership is transferred out of the U.S. even though the asset is still in the U.S. And that is an external asset for Japan from Japan's perspective. So consider the following equation. And this is, as you can see by the bolded word over here, this is very important to understand. So the financial account is essentially the net exports of home assets plus the net exports of foreign assets. And we can actually rearrange it to simplify the formula and say the financial account equals the net additions to external liabilities minus the net additions to external assets. Okay, so that's very important. And many of you will be like, what? Wait, I don't get that. So this is I'm not sure. I guess I struggle with this as well, but essentially the foreign account, you have your net export of home assets. So say, for example, we're talking about that sale of the sale of your home as a Canadian citizen. If that was the only transaction, then this would be positive, because in the end you are sending out you're exporting that home asset, whereas there are no transactions in the foreign assets, the foreign account is positive. But actually, I have a better example later on this. I think this one, yeah. So here, let's look at this example. So there are three transactions that occur. You sell your Florida home to a Chinese buyer for $500,000. With that money, you buy a cottage in Japan for $600,000, and to make room for that purchase, you sell some land in China for $200,000. So let's define these transactions. So the $500,000 sale in Florida is an export of a home assets, so it is an increase of external liabilities because it's being transferred out, and now it is an external liability because a foreign buyer holds a domestic asset. Now, the purchase of the $600,000 cottage in Japan is an import of a foreign asset, so it is increasing the external liabilities of the country. In addition, the $200,000 sale of land in China, which is a foreign asset and is being exported because it's being sold, is a decrease of an external asset. So these three transactions, the sale domestically increases the external asset, while there is two changes in an external. So the $500,000 sale in Florida is an increase in the external liability, whereas the two transactions offset each other for the external asset account. And so now we're looking at this side of the formula. So we have our net additions to external liabilities minus the net additions to external assets. Don't even focus on this side of the formula. That complicates things. The financial account simply equals the net additions to external assets minus the net additions to external liabilities minus the net additions to external assets. So in our example, we exported a home asset, a domestic asset. Therefore, there's a net addition to external liabilities of 500,000. And then with our foreign assets, there was a net addition to external assets because I sold $200,000 of external assets, but I bought 600,000. So the difference is 400,000. So 500,000 minus 400,000 equals a financial account of $100,000. So when the net export of domestic assets exceeds zero, there's an increase in liabilities, and when the net import of foreign assets exceeds zero, there is an increase in external liabilities. I think hopefully that helped. I'm not too sure. But so the financial account simply equals external liabilities, so the change in external liabilities minus the change in external assets. That is the big one. Okay? So net additions to external liabilities, net home asset sales to foreign buyers. We receive cash, but ownership is transferred to the foreign buyer. It becomes an external liability. For the net additions to external assets, the net import of external liabilities, that become external assets. So we're purchasing foreign assets and bringing them back into our country. Or we're buying home assets that were held by foreign buyers and bringing back to our country again, right? Hopefully you guys understood that. But let's take a quick overview. So we have our gross national disposable income, Y, equals GNE plus TB plus NFI plus NUT, which is GNE plus CA. And so gross national disposable income equals GNE plus CA. For the financial account, we can add the financial account with the capital account and simply say that the value of all assets exported via sales minus the value of all assets imported by purchases. So you have we can rearrange that and simply say, so for the financial account, it is the change, as we talked about here, the change in external liabilities minus the change in external assets. And for the capital account, we can say that it's the amount the amount of patents that are brought in minus the amount of patents that are sent out. And so that's the financial account plus the capital account. And so by adding GNE plus DA, which is GNDI, plus FA plus KA, so financial account plus the capital account, we get GNE again. And so we come full circle as we saw in the illustration earlier in the video. So this means that we can cancel GNE from both sides to identify the balance of payments identity, which is the BOP identity. And essentially that's if you were to cancel GNE from this side and GNE from that side, you will see that CA plus FA plus KA equals 0, must equal 0. And that's the BOP identity. The balance of payments sums to 0. Every market transaction has two parts. If party A engages in a transaction with counterpart B, then A receive from B an item of a given value, and B receives an item of equal value from A. Okay, so here's an overview. This is an example of the U.S. Balance of payments accounts, and so essentially we're going to kind of calculate the current account. For the trade balance, we can see the exports of goods and services is 1,571, and the imports of goods and services is 1,946. And so the net exports is actually negative. So it's there's net imports of $375. For net factor income from abroad, we have our income receipts, so the exports of factor services, which is 588, and then we have our imports of factor services of 467. For a net factor income from abroad of 121, and then our net unilateral transfers, being a developed market, was negative. There are a lot more people sending out money, largely made up of remittances, and so it was also negative 125. So by summing these three numbers up, we get a current account balance, a deficit of 378. Okay, and that's also represented. Where is it? Represented the balance. Yeah, so the current account, which is right here, CA equals negative 378. Okay, so a country that has a current account surplus is called a net lender by the BOP identity. We know that it must have a deficit in its asset accounts. So like a lender, it is buying assets. A country that has a current account deficit is called a net borrower. By the BOP identity, we know that it must have a surplus in its asset accounts. Okay, so recall that example with the whole, the transactions in Florida, Japan, and China. So the net result, the financial account equaled $100,000, and assuming that the capital account is 0. The reverse end of this means that if the financial account is $100,000, the capital account needs to be negative $100,000 in order for the BOP identity to remain true. And this makes sense. Say with the financial account, we have $100,000 coming into the country. Why do we need that $100,000? Well, to make up the $100,000 deficit in the in the current account, whether it was through net, like there was a net imports rather than net exports, or we needed to cover net factor income from abroad. That money that was taken from the financial account balances out the deficit in the capital account. So that's really important to understand. In addition to the BOP identity, another important concept is external wealth. An external wealth is a measurement of a nation's income flow. A measurement of a nation's income flow is not the only important economic variable that must be adapted to the open economy environment. Wealth is another important consideration. So, for example, Robert and Aaliyah have the same income and expenditures of $50,000 a year and savings in the bank of $10,000. However, Robert has a credit card debt of $20,000 while Aaliyah doesn't. Are they the same? Well, their expenditures might be the same, but, from a wealth perspective, Robert's credit, that the amount of debt that he has, actually gives Robert a net worth of negative $10,000, whereas Leah only has has a positive $10,000 net worth because she doesn't have any debt. And so, using this example, we can actually understand the nation's external wealth. And so the external wealth of a nation is simply the assets minus the liabilities of that nation. So the rest of world assets, so ROW is rest of world with respect to the rest of world, as you can see over here. So external wealth equals the rest of world assets owned by the home. So any foreign assets, external assets owned by the domestic economy is the assets, and the liabilities is the home assets owned by the rest of the world. So essentially, external wealth equals external assets minus external liabilities. It's simple as that. We've already covered that and should be relatively easy to understand. So when looking at those three transactions again, we exported a home asset and we imported a foreign asset, and this is included in an external wealth. So for us, we now, after the three transactions, we have foreign assets of $600,000 because we bought this cottage, and we have external liabilities of $500,000 because we sold the home. So our external wealth is $100,000. Before these transactions, external wealth was $200,000 because this was a home asset, so it's not recorded as an external asset. And we only had $200,000 worth of rest of world assets owned by home. And that change, you'll see this change from before of $200,000 to now $100,000, that negative financial account of $100,000 accounts for that. And so we'll show you, this represents that change. So if the wealth is positive, home is a net creditor country, external assets exceed external liabilities. If wealth is below zero, the home is a net debtor country, and external liabilities exceed external assets. And so when we were looking at that example, the country was a net debtor country. Okay, they had a negative current account balance. So as external wealth fell. In this example, external wealth did not fall below zero, but it did fall in that period. And therefore, whenever a country is a net debtor country, external wealth in that time period will fall. And if the country is a net creditor, external wealth will increase in that time period. Okay. So there are two reasons a country's level of external wealth changes over time. Financial flows, as a result of assets trades, the country can increase or decrease its external assets and liabilities. If net exports of assets are $1 billion, the change in external wealth is negative $1 billion. And so we talked about how, again, if we're sending out these assets, or if we're selling these assets to finance our current account deficit, the change in external wealth falls. So external wealth falls, or in addition, valuation effects. So the value of existing external assets and liabilities may change over time because of capital gains or losses. And that's not really an important factor that we're going to really account about. We're not going to talk about that in this book. But essentially, we can calculate the change in external wealth by negative the financial assets. So you just, again, for our financial account, it was $100,000 and we had no capital gains. So that change between the two periods was $100,000. It fell by $100,000, and that makes sense. The financial account was positive $100,000. We had a negative in front of that. And so the change in external wealth fell by $100,000. Using the BOP identity minus the financial account also equals the current account plus the capital account. So in our example, the change in external wealth, if we can replace this financial account with the capital account plus the current account instead of negative the financial account. And in this case, with the three transactions, we said that we had a negative $100,000 current account balance. with that negative $100,000 current account balance, you can see that the external wealth fell by $100,000. And this all kind of ties in together. Alrighty, so this fundamental formula tells us that the country can increase its external wealth in one of only three ways: through its own thrift, so it can have a current account surplus; by the charity of others, a current account surplus, a capital account surplus; or with the helps of windfall. So if the valuation of external assets increases and the value of external liabilities remains the same. So there are three ways a country can change its wealth: through its own thrift, the capital account surplus; through the charity of others, the capital account, or the capital account, or with the help of windfalls, the valuation changes. Whew. I was a little tired on this video, but as always, thank you for watching, guys. If you guys are interested in purchasing the book, I do recommend you check out the link in the video description to the Amazon page where you can buy the textbook. In addition, if you're interested in some of my research on seeking alpha, I do recommend that you check out my research below. I've provided a link in the video description. As always, please like and subscribe to my channel for more videos. Have a great day, guys.